Welcome everyone, happy Wednesday, another edition of #AskRobCo. Hope you're all well. Things are hotting up, not only with the weather, beautiful outside today, nice and sunny, feels like very much spring is in the air. Last few weeks we've been talking about the snow and the cold. The weather has been great the last few days and it looks like it's going to continue that way. So hopefully everyone has a good spring in their step and enjoying the outside, what they're allowed to do outside. And as timelines and lockdown 3 changes, even more time outside. We'll talk about that. James, welcome. Hope you're well.
Yeah, really good. Thanks, Rob. How about yourself?
Really good. Thank you. Really good. All right, let's get straight into it. We've got so much to talk about. As I said, things are hotting up in the property market with lockdown 3, the stamp duty holiday, the budget next week, the timelines that have been released by the government. Things are really starting to move. 2021 is really about to kick in, and we want to share with you our intel, our data, our knowledge, what we're experiencing, and start talking through the timelines of how we see March, April, May, June playing out within the market on the back of the information we're being told and we're hearing live as we speak. So thank you everyone for joining. As always, welcome. Keep on asking the questions, keep on updating us and me what you want to hear. We're going to try and hit all the areas that you work in: commercial lending, residential lending, hotspots, buy-to-let, build to rent, HMOs, prime, super prime, home counties, all of the areas and trends that we're seeing. So we're going to try and tap into all of that, as well as always, touching on mortgage product, risk, credit, sanction, pricing, policy, etc., etc. We're going to try and let you know everything that's going on in those areas. So let's move straight into this week's data. What we're tracking and sharing with you every week, which is handout number 1 on the right hand side. If it's numbered, I can't remember if it is. Yeah, sales data handout number 1, as always. Again, if you don't receive this by email, or you're not on your computer and you're listening on audio, or you're watching afterwards on one of the platforms, always happy to share this with you. And if you've got questions about this, please let me know. The real key thing we want to share with the data is it's all about the trends. It's all about what's happening with those trends to make decisions, predictions, manage our risk, manage our lending criteria from a sales and a risk perspective. So that's what the journey we're taking you on here with this data, and we're explaining what we see on the ground every week and how that relates to the live data. And as we keep saying, we're not working on a 3-month lag here or a 6-month lag, and this isn't historic, which doesn't really help us because it's something that happened previously. This is live, this is now, this is instant, and it's all related to the volumes and workload that we're seeing and the tendencies that are happening within the industry across all the different areas. So let's start with the 15th of February week commencing week 7 of 2021, the highlighted blue figures and numbers. And we'll start with the new instructions because that's the key indicator of where we're going to see performance driven in terms of transactional volume moving forward. And we've hit 341 this week, broadly the same as last week, 342. The trend is continuously but slowly moving upwards. What we expect now, without going in too deeply on stamp duty window extension and budget next week, what we're expecting now with lockdown, March 8th, schools going back, March 29, stay at home guidelines being relaxed, we're going to see that number go up and up. So new instructions started slow. We're probably 30 or 40% down on where we would have been January, February a year ago, because the market was so strong beginning of 2020. So the numbers are down. Also, the numbers are down on Q3, Q4 from 2020, which was tremendously buoyant in all aspects. And now those numbers are going to lift. So what are we going to see in March? We're going to see the 340 go to 400, go to 500. There's going to be a lot of property coming on stream, and there's going to be a lot of activity. That's going to happen, and we're going to see that progress on a north upward trend week by week by week moving forward at the moment. Let's look at the next key indicator, and probably the most important one for everyone on the call and everyone on the show that really determines the strength and how robust this market is, and it's the sold numbers. And again, the sold numbers are slightly up on last week, just over 200, 208 compared to 204. The trend has gone up and up week by week, but only small gradual steps, but going up week by week. What are we going to see moving forward into March? We're going to see that number grow, and we're going to see it go to 220, 230, 250, 270, and it should reach the dizzy heights of December of last year, where it broke 300, and that really is a big number. When we look at the historical tracking, and remember, we've been tracking this data and numbers internally for the last 5 years. These are high performance level and volume numbers, and I think that's the key point to share with you. It's on a 5-year basis, and yes, we understand that Q4 had 15-year highs in transactional volume and mortgage approvals, etc. But in 5 years of tracking the key areas that we work in, where we've got real strength and knowledge on our data and intel, this is really high performing numbers, and that's now going to continue March, April, May, because of the budget, because of lockdown 3 coming to an end, because of the pandemic hopefully coming to an end, because of the budget next week, and we're going to really discuss that. So headline data is new instructions north, that will continue and get stronger. Sold transactions, sales transactions north, that will continue to get stronger. And then when we do the breakdown analysis of our 2 to 3 to 5 to 10 million for all of you in upper tier prime, super prime, those numbers are strong. We're sharing with you where February sits for week commencing 15. So I suppose we've got 7-8 days left to close out the data. And if you compare and contrast the numbers of 5 to 10 million based on where we're at so far, we're virtually level with the whole of January. So we're going to exceed January. With 2 to 3 million, again, just under on the 3 million, quite a bit below on the 2 million. The chances are, in a short month that we're in, February is a short month, it should exceed all of the transactional volume numbers for 2, 3, 5, 10 million. And that shows the strength, especially 10 million, 5 million plus, of prime, super prime, and how it's performing currently in 2021, January, February. James, what are your views on what we've just mentioned, this key data and some of the points that I've raised?
Yeah, no, thank you, Rob. So, as we said, momentum in the market is continuing. The instruction numbers are almost identical to the previous week as we have reviewed them, while sold numbers are slightly up. So again, this is positive sentiment in the market. However, just in terms of what I would say is, whilst the sale figures are very, very high, they're comparable with Q4 of 2020, and whilst the new instructions are somewhat lower, so it's going to be interesting just to monitor that slight stock imbalance, and whether there is a real pipeline of new instructions ready and waiting for as we ease ourselves out of lockdown. That's the only thing that I'm seeing really, is that there could be some stock shortage just as we move into Q3, with obviously just such a high proportion of sales against the new instructions week by week.
Thank you, James. Let's talk and discuss the 3 really big areas at the moment that are really highlighted and everyone wants to understand, and everyone's been asking the questions for near on 1 year now, but as the weeks have gone by, especially in 2021, the questions and the question marks and the uncertainty and the volatility around these areas have grown, and now we're coming to a climax where we're going to understand so much better how the industry and the market is going to move forward. So let's touch on the three big areas at the moment, which are stamp duty extension, stamp duty holiday extension, lockdown 3 coming to an end, and those timelines across March, April, May, June, and the budget next week. All three, I would say, are separate issues within themselves and have separate permutations, and are all interlinked because in some way, shape or form, they affect each other. Let's start with the big one. It's the one that everyone's been waiting for months and months and months and months. It looks like from the breaking news last night that was reported that it's going to be announced next week in the budget that the stamp duty holiday will be extended by 3 months. And I would say it's not completely surprising. Possibly the 3 months is. I think we were talking on last week's that we thought maybe it would be 4 to 6 weeks just to allow those tail end deals to get over the line so people aren't penalized. What it looks like now is that that stamp duty holiday will be extended for 3 months, along with furlough, along with lockdown 3 ending, and everything now is going to get kicked down the road. So for 3 to 4 months, the can is just being kicked down the road to deal with the problem, if it is a problem, or the situation further down the line. And so what are the effects of that 3 month stamp duty window holiday extension going to be? Well, it's going to create demand, stimulus, activity for people to carry on pushing to get deals through and to have more activity because people want to take advantage of that window. And that's going to create a spike in the very short term and a lot of activity, a lot of instructions, and we're going to see sales driven off the back of that. And it's going to be frantic and frenetic for that period because of the extension. So that's definitely going to happen. What is that going to do? It's going to put tremendous pressure on the banks, on sanction, on credit, on risk, on conveyancing, on legals, on land registry, on searches, on valuers, on agents, on the whole supply chain. We're all, and everyone needs to get ready for this, we're all going to come under tremendous pressure again, like we were in September, October, and November, because of this pent-up demand and volume that we're now going to see. So be ready for that. That's going to happen. James, specifically on the stamp duty and what I've just said, any points on that so far?
Yes, thank you, Rob. So there's obviously widespread media reports that the stamp duty holiday will be extended by 3 months to the end of June 2021, which I think by most in the industry will be a welcome move. I think the only thing I would say is it's a slight disappointment that this has come at sort of almost the 11th hour, whereby the market has lost some of its momentum. And it just needs to sort of try and pick that up for the next few months if it gets extended. That's one of the points I would make. But also, we're sort of kicking the can down the road a bit, like you say. And what's going to happen when we reach the cliff edge of the stamp duty threshold ending? Where's the market going to go from there? The cliff edge, is it going to sort of fall off demand, activity, or is the market going to adapt? It's not to anything new, it's to how the market used to operate.
Yeah, I mean, let's be really consistent with what we're sharing here, and our viewpoint is that we felt that if the stamp duty holiday ended when it was supposed to at the end of March, and we felt that the market was robust and strong enough to continue performing well. And we've had experts on the data, the analysis has all been feeding through, suggesting that there was reason to believe that there could be a positive continuation of the market on that basis. By kicking it down the road for a further 3 months, I actually believe now it could strengthen the robustness and the confidence and market sentiment within the market. Let me explain why. Because now with lockdown restrictions being reduced and people being allowed to go out more, being allowed to work more, being allowed to live a more normal life as March, April, May plays out, I think that that will lead to more people putting their homes on the market, more valuations, more transactions, and they've got the incentive and the stimulus to do so because of product and pricing, a lot of 90% mortgage out there, some good low-level lending, and the incentive of the stamp duty holiday extension. So that is like a positive perfect storm. It's completely incentivized the people that were in lockdown in January and February, didn't put their properties on the market because they couldn't, they were scared, they didn't want to go out, etc. That's going to get dropped in March and April. More properties come on stream, more buyers out there because more people want to buy to take advantage of the 3-month extension. And all the other markets are slowly but surely coming back into play. So we've seen a nice positive growth in commercial activity in January and February that we didn't see, and that will get better and better as the year moves forward. So that means there'll be more confidence in the commercial market. We've seen a tremendous performing HMO market throughout 2020, and that has continued in 2021. There's a tremendous drive in that area. So we're saying commercial markets will improve massively on 2020 and because of the weak starting point that they had and how difficult it was to trade. That's only going to get better as restaurants and cafes, etc., open on April the 12th, and then other industries start performing in May and ending in June. So that's only upside and a positive. Secondly, the residential market has performed extremely well. It was tapering off slightly, as James mentioned, in January and February. Now that's going to get another kick and another surge on the stimulus and the lockdowns dropping, and potentially whatever comes out in the budget, which we haven't discussed yet completely, in terms of either tax changes or other incentives, which depends on which way you want to look at it. And then finally, the market will be really buoyant come May, come June. The sentiment across the country off the back of the vaccinations reaching 20, 25, 30 million by then. So over 50% of the country will be vaccinated. The pandemic in terms of COVID-19 and infections would have reached, let's hope, virtual zero. When I say that, obviously we understand it's never going to be at zero, but cases will be so low that it won't be something that people are fearful for on a daily basis as we get out of lockdown. And market sentiment and the uncertainty and volatility would have gone, and all this, because the can is being kicked down the line at the same time, road at the same time, will leave us in a positive position. And then the question will be, will we then fall off a cliff, or will that sentiment drive us through 2021? And I will throw it out there and leave it with you to think about. I think if the economic indicators are going to be positive, and if the economy is going to rebound and is going to be strong, it's going to be off the back of this perfect storm of sentiment, stimulus, incentivized investment, coming out of lockdown completely, all industries returning, and everyone having a feel-good factor. And I think that could happen. So I just want to give a little bit of a positive slant on the 3-month extension. If that comes to fruition, I think it could really feed into the market and allow for a really good third, fourth quarter of 2021. What are your thoughts on that, James? And any questions in the audience, please do ask, as always, because I think it's fascinating. We're really at a moment in time where things can go either way, and it's a fascinating discussion point.
Thanks, Rob. I think obviously Q1 2021 has been significantly hampered by lockdown 3.0, which has no doubt subdued the residential market. And despite the lockdown, I think overall it's performed well. As we brought you some of the statistics and data intel, the market has remained positive. There's good sentiment. There's increasing sales week by week, which is positive. And just while we're on that in terms of sales, go ahead, Rob.
Just want to interrupt. So on that specific one point, the data on transactions that went through the revenue were something along the lines of 225,000 in Q2, 316,000 in Q3, and Q4, we're just waiting for the final numbers, will be a further increase on that. And the revenues from those transactions in terms of the stamp duty, Q3 was 1.2 billion better off than, went from 1.1 billion to 1.35 billion from Q2 to Q3, and Q3 to Q4 will see a similar increment. So the government has seen that there's growth in revenue from the stamp duty, irrespective of the window for that bottom tier. Sorry, James.
No, I was saying that'll probably bring us on quite nicely. I've got some deals of the week just to bring the audience up together and what the activity in the markets. There's been two recent transactions in Belgravia, central London. One on Chapel Street, which got over £9 million, £2,000 a foot. Around the corner on Chester Street, another transaction at £11.75 million, a very high spec property which sold for over £2,200 a foot. Whilst we go over further into more Knightsbridge, Montpellier Walk sold for a penthouse flat there, sold for in the region of £20 million, over £3,700 per square foot. These are all in the last 10 days, so some record numbers being achieved there. And just to bring some positivity, as there is still activity going on in central London.
Yeah, I mean, so that the audience is aware, I've personally been tracking those deals, and one or two of them have been around for a good few years. And so to ask the question, why in January, February 2021 have a few of those transactions traded at very high numbers, at very strong price per square foot in locations that we've discussed over the months on this show that possibly wouldn't be the locations that would have performed the best. We've been talking about outdoor space and parks and villages and not so central. Well, these are very central locations in what we would call prime central London, and we'd call them super prime 10 million plus broadly transactions. And the question that we want to ask or share is, why would they be happening in those locations when a few of those properties have been on the market for a long time? Why would they be happening now? And one of the key answers is that there is a confidence and a robustness in the market that says people want to trade in those locations and those areas irrespective, and they believe that the product is a good product and it's where they want to be, and the prices being obtained reflect that confidence and sentiment within the market. And I think they're fascinating transactions. And again, as I said, I've followed those transactions for quite a few years, and for those transactions to happen in January, Feb 2021 is a massive statement, a huge statement to everyone out there trading in prime central London that this market means business. It's got some foundations to it, whether that's the schools, the legals, the attractiveness of London, the transparency, the currency, international marketplace, whatever the fundamentals are, for those transactions to be happening now is a big statement. I think everyone on this call should be aware, and you wouldn't be aware of those transactions if you're not having someone on the ground tracking those deals. I mean, these are live deals that we've been tracking and monitoring for a long time that we're so happy to share with you when they're positive stories.
Yes, and just following on with that, Rob, I'd like to link some of those deals of the week back to the stamp duty, which we were discussing. And if we just take the Chester Street transaction, for example, this has gone through in the region of £11.75 million. And in terms of the stamp duty on that property, including the discount at the moment of the first £500,000 holiday, that would work out to be £1.66 million, assuming that the person acquiring that property does own another property, which is extremely likely given that the purchaser profile for those types of properties are your sort of high net worth individuals who are active in the super prime sectors. So just as an effective rate on the stamp duty there on that transaction, it would work out to be 14.14%. And just in terms of, wanted to link it to holding periods for prime assets or upper tier residential properties. In order
Brilliant.
for that person to possibly sort of break even on that, the holding period has got to be at least sort of 5 to 10 years on that asset. And whilst so much of the market has traded in the last year, is that market going to be able to continue to grow and flourish in the coming years with such punitive stamp duty costs and purchasers' costs for those buyers?
Yeah, I think it's a brilliant question to raise, and I love that data. I think it could go one of two ways. It could be further long holder periods, or the sentiment and the demand could create more activity. And I think we're just going to have to keep an eye on that as the week goes by. Handout number 2, if you've got it. I don't know if all of you are aware of this new platform, Clubhouse. I've been speaking on it quite a lot, done some brilliant shows and had a great audience. Tonight, we've got a really, really great show, Prime London Property and Finance Special. Probably some of the key players in the entire industry are there. And I think that's going to be fascinating. It's 7:30 p.m. tonight. So you've got the invitation there. If you need help getting on that, please let me know. It's just going to be a great opportunity for you to hear live from the key movers and shakers of the prime London market. So I strongly recommend that you listen to that. 7:30 tonight. I will be there live along with a great panel. So strongly recommend that you listen and follow that. Closing point, James, from you?
No, I think as we were saying, Rob, on the topic of super prime assets, trophy assets can always buck the trend of what we anticipate, what we predict. So it's a fascinating market to track weekly, and one which always keeps us on our toes and is fascinating to watch and be involved in. Brilliant.
Big thank you to all of our core client base, fan base for supporting and following this show and platform. Is all for you. All of the data, all of the intel, all of the live activity that we're seeing on the ground, all of the content, all of the added value. It's a pure service for you. We are super grateful and super thankful for your support. Keep the questions and emails coming to us. Whatever information, whatever data, whatever intel, whatever question, whatever knowledge you want to know, commercial, residential, HMOs, buy-to-lets, prime, super prime, home counties, whatever you want, we're here to provide it for you, and we will continuously do that for you as the key point in the marketplace on a weekly basis, every week at 1 o'clock here. So thanks, James. Great input today, great data, great knowledge, and thank you to everyone for listening and sharing on all the platforms. Clubhouse tonight, 7:30. Strongly recommend. Get on that platform. You're going to get more from me, more questions, more answers, and a great panel tonight as well. Super Prime London Property Finance Special, 7:30 p.m. Otherwise, we will see you all same time, same place next week. Thanks for joining. Have a great weekend, everyone. Take care.
Thanks very much.